You've probably heard that the first £12,570 you take from your pension each year is tax-free. That's true if you have no other income. But most people watching this do have other income, and that changes everything. If you already get the full state pension, that's roughly £12,548 a year. That eats almost your entire personal allowance, so any pension drawdown you take on top is taxed at 20% from the first pound, even though you thought you were still under the limit. Over a decade, that one misunderstanding could cost you £50,000 or more in unnecessary tax. And it gets worse, because the way the tax is actually taken is a problem in itself. Emergency tax codes, PAYE confusion, providers treating your first withdrawal as though you earn £360,000 a year. Most people only find out something went wrong when they see their bank statement. I'm going to show you the exact mechanism behind this hidden cost and a three-step approach most people, and honestly a lot of advisors, completely miss. If you're within 5 years of retirement and juggling a state pension alongside private pension pots, subscribe now. This is precisely the kind of coordination trap I cover week after week on this channel. Let's start with the number that trips almost everyone up. The full new state pension for the 2025/26 tax year is £12,548. Your personal allowance, the amount you can earn before paying any income tax, is £12,570. That leaves exactly £22 of unused allowance. £22. So if you take even £1,000 from your SIPP on top of your state pension, thinking you're safely below the threshold, nearly every penny of that withdrawal is taxed at 20%. You'd pay £200 in tax on money you thought was entirely tax-free. This is the core trap. Your pension provider doesn't automatically know about your state pension income. HMRC will eventually sort out the tax code, but by then you may have already drawn several years' worth of income in exactly the wrong sequence. Many people try to sidestep this by taking their 25% tax-free lump sum up front. That feels sensible. You're taking the free money first. But then they carry on drawing taxable income from their crystallized SIPP year after year, unaware that the state pension has already used up the nil rate band. Over 15 to 20 years, a £300,000 pension pot could generate £30,000 or more in completely avoidable tax. Not because you did anything reckless, because no one explained how these two income sources interact. This isn't about being careless with money. If you've saved diligently for decades, you expect the system to behave simply. But the tax code was built around a single source of pension income. It was never redesigned for someone with a state pension, a defined benefit pot, and a SIPP all coming in at once. The trap is in the structure, not your choices. And here's the part that catches people mid-retirement, not just at the start. Once you begin drawing taxable income from a flexi-access drawdown account, you trigger something called the Money Purchase Annual Allowance. And once that's triggered, you cannot go back. The Money Purchase Annual Allowance is one of those rules that almost nobody warns you about until it's too late. Here's how it works. If you take any taxable income from a flexi-access drawdown account, even just £1, the amount you're allowed to contribute to a pension drops permanently from £60,000 a year down to £10,000. That's the MPAA, and it can't be undone. Here's what makes this so easy to trigger by accident. Taking your 25% tax-free lump sum does not activate the MPAA. But the moment you take even a small taxable withdrawal, perhaps to test the system or cover an unexpected bill, the rule kicks in immediately. The practical cost can be significant. Say you take £5,000 in taxable drawdown income in April. A few months later, you inherit £50,000 and want to put it into your pension for the tax relief. You can only add £10,000, not £60,000. The remaining £40,000 either sits outside your pension with no shelter, or it misses out on any further contributions entirely. At a 20% relief rate, that's up to £8,000 in tax relief you can no longer claim. The people most at risk here are those who do one early withdrawal to get their provider's payment system set up, then plan to contribute more later from freelance work, redundancy pay, or an inheritance. They've unknowingly closed the door on the larger contributions they were counting on. So the instinct to avoid the MPAA entirely by never touching taxable income is understandable. But that creates a different problem. Your pension pot keeps growing, your income needs in retirement are real, and at some point you'll need to draw something. The question is in what order and from which pot. That's where the ISARE becomes the unsung part of a proper drawdown plan. Most drawdown advice treats your pension as a single pot. You take your 25% tax-free, then draw the rest as needed. The problem is that this ignores how the state pension interacts with everything else. If you have a state pension, a SIPP and an ISARE, which describes a large proportion of UK retirees, you don't have a drawdown question, you have a sequencing question. Which pot do you take from first and in what order? Honestly, for years I thought the right move was to take the 25% lump sum up front, then draw the rest when you need it. It was only when I started modelling what this actually looks like year by year that the real cost became clear. Here's how to think about it. There are two distinct phases in retirement, and each one calls for a different income source. The years before your state pension starts are the golden window. During that period, your personal allowance, £12,570, is sitting there completely unused. If you're retiring at 63 and your state pension doesn't start until 66, you have 3 years where you can draw taxable SIPP income at a zero rate. Using a method called a ufpls, an uncrystallised funds pension lump sum, you can take £16,760 from your SIPP each year. £12,570 of that is taxable but falls within your personal allowance, and £4,190 comes out automatically tax-free as the 25% element. Total tax paid? Nothing. Let's put some numbers to it. Take David. He's 63 and retiring this year. He has a £250,000 SIPP, £50,000 in an ISA, and a full state pension coming at 66. He wants £25,000 a year to live on. In Phase 1, he draws £16,760 from the SIPP using ufpls, zero tax. He tops that up with £8,240 from his ISARE, also zero tax. He has his £25,000. For 3 years his tax bill is nil. Then the state pension starts. Now the calculation flips. His £12,548 state pension uses up almost all of his personal allowance. So he stops drawing taxable SIPP income entirely. For the rest of retirement, his income top-up comes from the ISARE. Every pound he takes is tax-free and doesn't count toward any threshold. His SIPP stays invested and keeps growing, and he holds the remaining uncrystallised funds as a reserve for large one-off expenses. Done the wrong way, taking all the tax-free cash up front and then drawing taxable SIPP income throughout retirement, the same pot would generate £30,000 to £50,000 in additional tax over 20 years. Same money, different order. The catch is that getting the first withdrawal right is harder than it sounds, because your provider may apply emergency tax before HMRC has any idea what your income picture looks like. Even if you've got the sequencing right, drawing from the correct pot at the correct time. There's a practical hurdle that catches almost everyone on their first withdrawal. When you take your first payment from a pension drawdown account, your provider doesn't yet know your full tax position, so they apply what's called an emergency tax code, usually code 0T, on a month-one basis. What that means in practice is the system takes your single withdrawal and treats it as if you'll receive that amount every single month for the rest of the year. Then it taxes you accordingly. Say you take a one-off £20,000 from your pension in June. The provider system annualises that to £240,000 a year and deducts tax at the higher rate. You might see £8,000 or more taken from that payment, when the correct tax, assuming you have no other income, should be a fraction of that. Here's what the maths actually looks like on a £20,000 UFPLS. The 25% tax-free element is £5,000. The taxable portion is £15,000. If you have no other income and a full personal allowance of £12,570, the actual tax owed is £486. That's £2,430 over the threshold at 20%. But under emergency coding, you could easily have £6,000 deducted. That means you'd need to reclaim £5,514 that was never owed. You can reclaim it. HMRC does have a process. If you've stopped working entirely and have no other income, you use Form P50Z. If you have other income sources, state pension, rental income, a defined benefit, you use P53Z. If you've only taken part of your pension and there's more to come, use P55. In normal circumstances, reclaims are processed within a few weeks. But not everyone knows to do this. Some people assume the deduction was correct and move on. Others wait until self-assessment and only get the money back a year or more later. If you have multiple income sources, which many people reading this will, you'll likely end up needing to file a self-assessment return anyway. That's how HMRC reconciles your state pension, SIPP income, and any other sources into one tax calculation. Getting your tax code corrected early avoids a backlog later. The simplest way to reduce the emergency tax hit on your first withdrawal is to make it a small, deliberate one, enough to establish a payment in the system and trigger HMRC to issue the right code before you take any larger amounts. Now let's make this practical. 4 steps you can apply regardless of where you are in the timeline. Step 1 is build a cash buffer before you touch your pension at all. Ideally 1 to 2 years of essential spending, sitting in a savings account or cash ISA, somewhere accessible, not invested. If your essential monthly costs are around £1,500, that means having £18,000 to £36,000 set aside. This buffer means you're never forced to sell pension investments at a bad time because the market fell and you need income next month. Step 2 applies in the years before your state pension starts. This is your window to draw from the SIPP at zero tax. Use ufpls withdrawals to take £16,760 from your pension each year. £12,570 of that is taxable, but sits within your personal allowance, and £4,190 comes out automatically tax-free as the 25% element. Top up whatever remains from your ISA, your total tax bill for the year, nothing. Step 3 is when your state pension kicks in. At that point, stop taking taxable SIPP income. Your state pension will use almost all of your personal allowance, so any SIPP withdrawals you add will be taxed at 20% from the first pound. Instead, draw what you need from your ISA. Every pound is tax-free and has no effect on any income threshold. Leave your SIPP invested. The uncrystallized portion still has its 25% tax-free element available. Use that for big one-off costs like a car or home repairs, not for regular income. Step 4 is for the situations where your ISA runs lower and you do need some taxable SIPP income. If you need a larger sum, say £30,000, split it across 2 tax years. Draw £15,000 before the 5th of April and £15,000 after the 6th of April. Both withdrawals stay in the 20% band, instead of potentially tipping into 40%. That one decision, spreading a withdrawal over 6 weeks, saves roughly £3,000 in tax on a £30,000 draw. I know it sounds like a lot of administrative work, but most of this is a one-time plan that you set up at the start of retirement and adjust annually, not something you're managing month to month. If you want a clear walkthrough of how to calculate your own optimal sequence, subscribe and turn on notifications. I'll be releasing a step-by-step breakdown in an upcoming video. The biggest reason people end up overtaxed in retirement isn't ignorance, it's delay. The thinking goes something like this: I'll figure out the drawdown rules when I actually need to take money. Or I'll just use an IFA when the time comes. So the planning gets pushed back 6 months, then a year, then 2 years, and before long the state pension has started, the golden window has closed, and the tax-efficient years are gone. This is completely normal. The UK pension system is genuinely complicated, and you've spent 30 or 40 years being told to save. Nobody taught you the spending side. The paralysis you feel when you look at drawdown rules is not a character flaw. It's a rational response to an unnecessarily complex system. But here's a shift that makes it more manageable. You don't need to have the perfect strategy worked out before you start. You only need to get the first year right. HMRC gives you information every time a payment is made. Your tax code gets updated. You can adjust the following year based on what you actually see. If you're not sure where to begin, make one small deliberate withdrawal, even £500 using ufpls, just to get a payment on record and prompt HMRC to assign you a tax code. That one small action breaks the paralysis and gives you real data to work with. Let's bring this together. The biggest mistake in pension drawdown isn't taking too much or too little. It's treating everything as a single pot and drawing from it without a plan. If you have a state pension alongside a SIPP and an ISA, the sequence matters more than the amounts. Use the years before your state pension starts to draw taxable SIPP income at a zero tax rate. Once the state pension begins, switch to your ISA for top-ups and leave the SIPP largely untouched. And if emergency tax catches you on your first withdrawal, know that it's reclaimable. And there's a form for that. You've been saving for a long time. The last thing you want is to hand over £50,000 to HMRC because of a sequencing mistake rather than a genuine tax bill. The income trio framework, state pension, SIPP, ISA, used in the right order, can reduce your lifetime tax by tens of thousands. It doesn't require specialist software. It requires a clear picture of your income sources and a bit of timing. If you want a step-by-step plan built around your actual situation, not generic advice, subscribe. I'll be back next week with the next piece of this.